A warm and hearty welcome. Hello, everyone. Welcome to our Taxand webinar today on planning for Pillar 2. What do you need to know? With myself, Nadia Altenburg, and my colleagues from Taxand that I will shortly present. But before we go through the agenda and my fellow speakers, I would like to go through a couple of notes, which is the first and most important one. We would love to hear from you and hear your questions, hear your ideas, your concerns. So please do not hesitate to put any of your questions in the QA box that we can see, and we can either address them directly by the end of this webinar or get back to you at a later point. We would also like to point out that we are envisaging to make a series out of this webinar by continuous feedback that we get from clients during our work on Pillar 2. So if you have something that is really concerning you, like if you should invite speakers from another tax and jurisdictions, if you should address certain topics that you're struggling with, please reach out to us and we will consider that in our next webinar. Also note that we will circulate the slides of today's webinar after the presentation, and you will find also the speakers' profiles and contact details at the end, so you can reach out to them directly for any further questions. So let me now introduce our speakers of today. We start with Maria, who is a partner with Skeppsbron Skatt. She has a vast and broad experience of advising both Swedish and international clients active in a variety of sectors with a focus on international corporate taxation and various group taxation issues. And she also provides advice in tax audits and tax litigation. Andreas is here. He is a principal at ATOZ with more than 12 years of experience and focus on international taxation and transfer pricing of financial transactions. Romain is a tax lawyer with 10 years of experience in corporate and international tax law. And last but not least, Christos is an expert in international tax and transfer pricing. He's a partner at Taxand, Cyprus. So let's get going with the content of today. Time is short, but we tried to pick a couple of items that might be interesting for you for the year end and in preparing for Pillar 2. So we keep the introduction of the technique of the global rules quite short, and we assume that you have already a basic knowledge about the basic rules and how they will apply. We will then go on with the other items that you can see here, like determination of UPE, transition period, treatment of losses, asymmetric exemptions, impact of tax credits on the ETR, and how to handle substance in your future structure thoughts. So to start, as you have seen from the model rules published by the OECD by the end of last year, to determine a potential top-up tax, we have to calculate the effective tax rate, not of a single entity, but of a jurisdiction, which means that we have to determine the covered taxes, which is a specific term under the global rules. So it's not only taxes, but it also might be deferred taxes or other items that might be subject to further manipulation. And you have to determine the global income, which normally starts with the P&L and has a variety of different steps to be adapted, similar to the work that you do to arrive at your tax accounting. Once this work is done, you do the calculation, you divide the covered taxes by the global income, you get another percentage. If that percentage is bigger than 15%, you're fine. If it's lower, you have a percentage left that you have to multiply with the global income. However, if you have a substance which is either tangible assets or employee cost, you can subtract that from your global income, and then that would be the basis that you would multiply your relevant percentage to determine your top-up tax. I just give you an overview because we're circulating the slides with the several steps that you have to do, and we all know it is challenging, and it's also challenging to get the data. So if you have any need for further support, please feel free to reach out to us. This gets us right to the first step in what like what is the importance of the UPE and how can I determine the UPE? And I hand over to my colleague Maria.
Thank you, Nadia. Yeah, another technical part of this is to actually define which company is the ultimate parent entity in the group. And why it's important to decide that is because it's the ultimate parent entity that is reliable to pay the top-up tax. And the UPE is liable to pay the top-up tax in relation to its own allocable share of the top-up tax. So when you have kind of concluded that there is a top-up tax to be paid, then for the group it's important to know which entity is to pay this top-up tax, which is to be paid with the tax agency in the country where the ultimate parent entity is located. Of course, there could be exemptions to this depending on how the rules will be implemented in which countries, etc. But looking at the definition of the ultimate parent entity that is outlined in the model rules as well as the directive, and it is defined as an entity that owns directly or indirectly a controlling interest in any other entity. And this, in addition to that, the ultimate parent entity in itself should not be owned in itself by any other entity. And so it's basically, it's the top owner, which in itself is not held by anyone else, which has a controlling interest in its shares. And so looking at the definition of what is in fact a controlling interest, that is also outlined in the rules. And that is defined as an ownership interest in another entity, which means that the shareholder is required or should have been required to consolidate on a line-by-line basis, both assets, debts, revenue, costs, and cash flow. And that should be in accordance with acceptable financial accounting standard. So there it comes back to the definition in the financial accounting standard. So we can take the next slide, please, Nadia. So when you have this kind of that you fall back on the accounting financial standards, you have to go back and see. And if you look and see in, for instance, the IFRS, what it says, it is the entity that is required to consolidate another entity. What is the definition under the IFRS, which is a commonly used accounting standard? Here it says that it's decisive whether the entity has a controlling influence in the other entity. And the obvious cases, here you can see that it falls back to if the entity holds more than 50% of the votes in another entity, then it actually has this controlling influence in the other entity and is required to consolidate that entity. There could, of course, be in other ways. That's the most obvious case are that you look at the votes. We will try to illustrate this by going through a case here. And in this situation, we have a top company which holds a holding company, but this holding company only holds 5% of the votes, but 84.7% of the shares. On the other hand, we have a company named here X, which holds 90% of the votes, but only 1.7% of the shares. And then we also have a third company on which holds the remaining votes and shares here. So what we can see here is that the company X holds more than 50% of the votes in company Z, and indirectly in the other underlying entities. Because in this example, we have underneath company Z, we have low taxed constituent entities for which there is potential top-up tax to be paid. So in this case, company X is considered to be the ultimate parent entity, since it holds more than 50% of the votes and is required to consolidate the accounts for company Z and the underlying companies. Company X is not required to consolidate for the other companies marked in blue here, the holding company, the top company, and the company Y. And based on that those are not companies that are required to be included in the consolidation, then they are also not considered as companies within the group under the definition in the rules. So that's why they are marked in blue here, that they are outside the group. And that's kind of which party is then responsible for paying the top-up tax here. In this situation, it's also important to see if you, in the structure, beside defining the ultimate parent entity, if you have any company which is falls under the definition of being a partially owned parent entity, a so-called POPE. And the definition of a POPE company is that there's a constituent entity that owns an ownership in another constituent entity within the group, but in itself has more than 20% of the ownership interest in its own profit is held by external companies which are outside the group, by persons that are not constituent entities of the group is the definition. So in this example here, we have company Z is held by more than 20% of the ownership interest is held by the blue companies, which are considered to be outside the group. So here we can see that company Z is actually a partially owned parent entity. And why is that important to define? That is because the POPE company, when you have a POPE company within your company structure, then the liability to pay the top-up tax is moved down to the POPE company in relation to the top-up tax for low-tax constituent entities that are underneath company Z in this example. But what happens then is that company Z is liable to pay top-up tax, but company X, as an ultimate parent entity, is liable for its own part of the top-up tax in relation to the 1.7% shares which it holds in company Z. What we have then is that in the rules, we have a credit mechanism, which means basically that company X in the end doesn't pay anything because it can credit the top-up tax in relation to that part which is paid by company Z. So this kind of shows the importance of deciding or analyzing and see which is the ultimate parent entity within your group. Do you have any partially owned parent entities within the group? 20% is not that much, which, what we have seen is that it's quite frequently that there are actually POPEs within the company structures. And kind of do this homework well in time for the implementation of the rules. And if you also, when you do this exercise and see that, well, you may have implications, you may have an unwanted situation where you actually pay top-up tax, etc., by an entity or country in your country which you don't want. There could be a possibility within this, looking at that you have this parameter with the voting, which is you come back to when you look into the financial accounting definition of controlling interest, which leads us to that there may be possibilities to, given this deviation between voting rights and ownership interest, to explore possibilities on that side when you look into your situation. in certain situations. So it's kind of the takeaway of this part is to look into your situation and that there may be options to explore alternatives.
Yes. Thank you,
and
Maria.
having this said, yeah.
Sorry. I'll let you. Sorry.
Yeah, with this said, I will just hand over to Andrea as on the next topic here.
Great.
Nadia.
Yes, thank you, Maria. This is really interesting because it actually shows you that if you want to do something, you have to actually start talking to your auditors of this year to prepare them for the process by next year if you want to change the entity that is consolidating in the future, if you change the controlling voting rights, right? So,
exactly.
Thank you very much. So I will have some points on the transition period now that you should also keep in mind already this year, latest early next year, before starting into the global world. And I'm addressing the transition rules in Article 9, one of them being Article 9.1.1, which tells us that any deferred tax assets and deferred tax liabilities reflected or disclosed in the financial accounts of the constituent entities in the jurisdiction for the year of transition can be transferred for global purposes. They then will have to be recast at 15% if the evaluation is higher. So it seems in the first moment to be okay, especially when you're treated under IFRS. However, if you belong to one of the many M&E groups, like for example in Germany, that doesn't prepare accounts under IFRS but under local GAAP, you might want to verify whether all of the DTAs are actually reflected in your accounts. Because, for example, under German GAAP, there is an election to which extent you show DTA, whether you net them with the DTL or whether you show them at all. And I understood under Lux GAAP, and Andreas, you jump in and correct me, that you're not allowed at all to show DTAs. And there might be even... Sorry? Yeah.
Lost DTAs at least.
Lost DTAs, yeah. So there might be, again, a difference between DTAs created for other items and for losses. If we're only considering the DTAs for losses, the issue might not be as important because the global rules tell us, and here I can calm you a little bit, that no matter whether you show a DTA in the full amount for loss or you had a reevaluation for a 5-year period, such lost DTAs or fictitious lost DTA will always be considered in the full amount. And this is also reflected in the Article 4.4, where it says any revaluation of a lost DTA is not taken into account for the ETR calculation, which means that if you have huge loss carry forwards now that are not fully reflected in your accounts, you can still bring them into Globi. But if you have other DTAs relating to other items, they might not be fully reflected. And then you have to watch out for 2 items, because one of them is, if the global rules later tell you that you are allowed to consider them, you still have to know that you have them somewhere or that you could have created them. So it's like an exercise for you to not lose track. Or it might be that in jurisdictions interpret it in a different way and they simply do not foresee to allow you. So my recommendation would be go through it and make sure that all the DTAs, because if the DTA reverses, it's obviously a tax expense that you want to have, that all the DTAs are in your accounts already now. This also raises the questions of financial accounts, because there is no formal definition in the Pillar 2 directive or in the global rules. It only refers to the starting points. Are the financial accounts used for consolidation purposes? So there is still also something that you have to watch out for once the domestic legislator is starting to put in definition and is telling you what you can actually use and what you can't use. So this is nothing yet that you can prepare in advance, but something that you should watch out for in your respective jurisdiction. The other item I want to raise is to keep in mind when you are transferring assets now this year and next year, maybe also with the view of reorganizing yourself for global purposes, that there is this Article 9.1.3. And it tells you that if you have an asset transfer at fair market value, so no reorganization, tax act, book carryover, but actually transferring something at fair market value for accounting purposes, right? This might not, well, this not only might not, this is not reflected under the global rules. So the global rules would pretend that any transfer that has taken place after 30th November last year, 2021, up to the point when Globi comes into force, will be treated as a transfer at the book value. And any higher depreciation resulting from a fair market value or any further sale by the recipient entity will not be considered, but will have to be corrected under Globi. There are many, questions rising with that. In Germany, we would have a constitutional question about retrospective legislation, and also the ability of paying taxes. So there's, many things where you can address it, and the OECD has also seen it, because the rule currently doesn't differentiate whether the sale of such asset has been taxed at all at 15% or above 15%. And we are expecting some correction, but this is how it looks like for the moment. So if you have planned to transfer any asset at a fair market value, maybe you want to double check that and wait for further clarification from the OECD. The other question, and I might not know whether you have, if you have listeners today which are active in a group below 750 turnover, but are about to enter this or exceed this threshold, the way that the transition year is defined for the moment implies that the transition period for this Article 9.1.3 starts on the 30th November and goes until the year that you enter the global world, which means if you only exceed this threshold in 5 years, your transition period might be already 7 years. We are waiting for the guidance. It was announced before Christmas. It was announced already September, then it was announced to be before Christmas. Now I've heard that there might be some further delay, but please keep that in mind and please watch out for that when doing transfer of assets, and maybe you consider restructuring it in a different way. Andreas, this is where I hand over to you.
Thank you, Nadia. I would like to give a brief overview on the treatment of tax losses under Pillar 2 and to illustrate a few structural issues that may arise in this context, also based on a few numerical examples. It's only a few selected issues. I think the uncertainty goes way beyond that, but I think it's a good starting point to create awareness of a potential issue. The key issue when talking about tax losses and the potential use of tax losses is that a taxpayer that has a massive amount of tax losses available under Luxembourg tax law is under Pillar 2 not able to fully use those Luxembourg tax attributes to the fullest extent, as we will see in these numeric examples, due to that asymmetry, which is also intended is asymmetry that has been introduced by Pillar 2. The issue being that tax loss DTAs need to be recast at the lower of the Luxembourg domestic tax rate or 15%. And given that Luxembourg has an effective tax rate of close to 25%, which may also vary depending on the municipality we're talking about, but it's in the average it's close to 25%. That means that taxpayers are effectively losing value on their DTAs, and they're losing potential to effectively use them. And as Nadia has already introduced before, the tax loss DTAs, they play an essential role also when it comes to the computation of the effective tax rate, meaning that as we see later on, both for symmetrically treated income under Pillar 2 and Luxembourg tax law, and especially for asymmetric treatments under global rules and domestic rules, there will be a discrepancy that's arising. And how this will play out in the accounts and also for tax purposes, I will try to illustrate in those two examples. So as a very like standard starting point, we would use like we take the example of a Luxembourg company with tax losses of 45 million euros, as you can see in the table. And what we would currently do if we're accounting under IFRS, because as Nadia said, like Lux GAAP rules, they do not recognize any loss DTAs, at least at this stage. We would have a tax loss DTA of like a bit above 11 million euros, whereas like the reassessment under Pillar 2 rules is leading to a revalued DTA for only 6.75 million euros. So you can already see like the capacity to use the tax attributes is already decreased to that revaluation. And that leads to a number of like follow-up questions that we will see on the next slide. Nadia, please.
This one?
Yeah, could you go to the... Thank you. So in this example, we take like interest income being realized by a Luxembourg company that forms part of an M&E group of 20 million euros. Under Luxembourg tax law, it's like quite straightforward, because like the entire income is fully sheltered by the tax losses carried forward. Because under Luxembourg tax law, there are only like very few limitations with regard to the effective use of tax losses. So that's rather straightforward. However, under Pillar 2, we need to make the effective tax rate test because effectively there's no tax being paid in Luxembourg. However, coming back to the question of tax loss DTAs, we can like consider the amount of tax loss DTAs that has effectively been used or that has been accrued as a deferred tax expense in the accounts for the computation of the effective tax rate. And in the case at hand, that would be like the recast of the DTA use based on the 15% Pillar 2 tax rate, leading to like an effective taxation of 15%, because we convert kind of the amount of tax loss DTA that has been used under Luxembourg tax law and reassess them at the 15% rate and effectively arrive at like exactly the minimum tax rate, and there wouldn't be any top-up tax. And the next slide is also illustrating that. That's something I don't want to go through in detail, but that's just serves as like also like some reading at home. You can see like effectively the DTA, the loss DTA that has been used for IFRS purposes is close to 5 million euros, whereas the effectively considered tax loss DTA under Pillar 2 only amounts to 3 million euros, which is underlining again this like significant kind of reassessment in the value of tax attributes. And going to the next slide, the problem becomes a bit more vivid when we look at asymmetric treatments, because like the first slide was about like a symmetric treatment, like included income under Globi rules and fully taxable income under Luxembourg tax rules. And now I've picked a few selected issues that can arise in the context of the participation exemption regime in Luxembourg. That structurally and conceptually, that issue also arises in a couple of other countries, and Nadia will also comment on that later on. So it's not only a Luxembourg issue, but the Luxembourg participation exemption and the way it has been construed bears like a lot of like risk of asymmetries in there. Because in a nutshell, Luxembourg, like the Luxembourg participation exemption for dividends and capital gains that I have picked here, relies on like a 12-month holding period, and on the other hand, like a 10% holding requirement with regard to the shares in a company. However, there are also different alternative criteria as opposed to the 10% threshold based on the acquisition cost, and they also vary depending on whether we're talking about dividends or capital gains. And this table is like summarizing a bit like the potential issues, because, for example, for dividends under the Luxembourg participation exemption regime, it would be sufficient to have like an acquisition cost of like 1.2 million euro in the equities held, even if it's below 10%, assuming that this has been held for more than 12 months. On this very first example, in the first line, we don't have any asymmetry because that's aligned with like the outcome under the Globi rules. However, where it becomes interesting is like still remaining below the 10% threshold. If we have like an acquisition cost base of 6 million euros for a certain shareholding, which we hold for more than 12 months, we would be exempt for dividends and capital gains under Luxembourg tax law, whereas we would only qualify for the excluded dividends under Globi rules, whereas like it would still be an included equity gain. And that's where like we can see like a number of examples. I don't want to go through all of them line by line, but where you can see that there's like a certain asymmetry, which is creating like practical issues when it comes to the utilization of losses at the risk of top-up tax being levied, although the company is in a huge loss position. And another structural issue of the Luxembourg participation exemption also comes from the fact that we look at a shareholding on an overall basis. So even if you buy several tranches of a given shareholding, we would look at this on an overall basis, where this is debatable, at least for the holding period under Globi rules. And in particular, Luxembourg also provides for the commitment to hold a certain shareholding for 12 months. And that's a particularity of Luxembourg law, where like you could acquire a qualifying shareholding of like 1.2 million euros, but below 10%. And after a few months, you already receive a dividend. And if you're not in breach of like the minimum thresholds defined by law over the next 12 months, you can still achieve an exemption. So that creates another structural issue here in terms of timing. And this one has been summarized in a short slide with an example. I don't want to go through this in like a lot of details, but in essence, what happens is like our Luxembourg company buys like 2 tranches of shares in the same issuer. The first one being held for already 12 months at the time the dividend has been distributed, whereas the second tranche has only been acquired recently, meaning that the second tranche does not benefit from the 12-month carve-out under Globi rules. From a Luxembourg perspective, that's not an issue because, as I said before, we look at the shareholding on a global basis, and the fact that we have already acquired the first tranche more than 12 months ago is already positively impacting the second tranche, meaning that the entire income is exempt for Luxembourg tax purposes. However, for Pillar 2, we have a few structural issues. First of all, the commitment to hold a shareholding for 12 months, that wouldn't be covered by Pillar 2. And also there's like a clear policy intention under Pillar 2 saying that like, although they want to provide for a very broad exemption of dividend income, for example, to align that with the various participation exemption regimes in the different jurisdictions, there's clearly an intention not to kind of give incidental benefits to companies that pursue trading activities, for example. So that means companies with like equity trading activities, they are like clearly at risk of being in the scope of the top-up tax here. And if you could go to the next slide, please. And this is what has been kind of illustrated in this slide. So if you look at the left column, the first tranche is like fully exempt under Luxembourg law and is also considered as an excluded dividend under Globi rules because it has been held for more than 12 months. So that's a rather uncontroversial issue. And the second tranche would equally be exempt under Luxembourg tax law. However, it is very likely, at least based on the current interpretation of the Globi rules, the second tranche wouldn't qualify as an excluded dividend, meaning that it needs to be included in the Globi income computation. But the issue being that from a Luxembourg perspective, the entire income is exempt, so there's no effective use of a tax loss DTA. And the fact that there's no reduction in the tax loss DTAs, so there's no deferred tax loss adjustments as per the Globi rules, means that like we cannot even use our existing tax loss DTAs for the effective tax rate computation. That means in this specific example, the Globi effective tax rate would be 0, meaning that there would be an additional top-up tax of 6 million euros, although we have like a bunch of tax losses to shelter the income. Hence, like there are certain strategies that are being discussed at the moment. For example, can the participation exemption regime be considered as optional so that a taxpayer could opt out of the exemption voluntarily, which is kind of counterintuitive because now we're talking about companies being voluntarily taxed on their income. However, in such a case, you would like if you made that income taxable and made the participation exemption regime optional, you would effectively use your tax losses and reduce your tax loss DTA, meaning that in such a case, although your tax base is higher in Luxembourg, your effective tax would be lower because you're not suffering the top-up tax. And that's a more general question that I think Nadia will also touch upon briefly later on. So as one strategy, the question is the participation exemption regime optional? Can we opt out? And that gives us also the ability, or gives the taxpayer the ability to align the results and effectively make sure to be able to use the tax attributes that are reflected in the accounts. And as a last point, before closing my presentation, one interesting part here would be if we are still talking about those two tranches, and I would voluntarily opt in to being taxed on those dividends. Interestingly, the tax in Luxembourg, or the tax that would be the deferred tax expense in relation to the first tranche, would not be able to be considered for the ETR computation either. So that's kind of a loss of lost DTA, because you cannot consider for your ETR computation under global rules any tax expense or deferred tax expense in relation to an excluded dividend. So these are some general considerations on the participation exemption regime, and now I would like to pass on the word.
Thank you, Andreas. Yeah, that's a very interesting item, because when you read it at first and you think, okay, even if I have portfolio, if I hold it in longer than 1 year, it will not be an issue anymore for Globi. But in fact, because it's portfolio, I don't have any impact when dividends are distributed. And depending on the amount, it can be quite impactful on your ETR calculation, depending on your overall tax rate. So thank you very much. Romain, I will hand over to you and the specifications of the French IP box to explain the impact of tax credits in general on the ETR.
Yeah, thanks, Nadia. So I will address the topic regarding the impact of tax credits on the effective tax rate, so-called ETR. This topic is quite critical. Indeed, it can significantly impact Pillar 2 rules by reducing the ETR below to the 15% rate. So it's key to understand how they should apply. The first question, as mentioned in this slide, is how tax credit impact the calculation of the ETR. Please remind, as mentioned, that the ETR is determined by dividing the sums of the covered taxes by the sums of the globe income. So the question is do the tax credit reduce the covered taxes or increase the globe income? Depending on this allocation, the reduction of the ETR will be more or less important. The decrease of the ETR will be higher if the taxing impacts in the tax credit impact the covered taxes, like mentioned in red in the slide. So let's move on to the next slide to determine the impact of tax credit on the ETR calculation. The GLOBE rules make a clear distinction between two categories of tax credits. The first one is the qualified refundable tax credit, and the second one is just simply called the other tax credits. So a tax credit constitutes a qualified refundable tax credit if two conditions are met. The first condition, and I think it's the main condition, is that the tax credit must be refundable within 4 years when the company satisfies the condition for receiving it. The second condition is that the refund mechanism has a practical effect for the taxpayer. I think that it means that if the design of the tax credit is such that it will never exceed any taxpayer's liability, this second condition, will be considered as not being met. So the qualified refundable tax credits will increase the global income. These tax credits are generally incentives to engage companies in certain activities such as research and development, whereby governments allow companies to offset its taxes euro for euro for engaging in specified activities. It is, for example, the case for the French or the Italian research tax credit. This type of tax credit should be treated as an income. No. The government effectively pay for the activity in a similar way to a grant or a subsidy. No. The other tax credits are the ones which not meet the two above mentioned conditions. This tax credit is deducted from covered taxes for the ETR calculation. For example, in this category, we notably find the US R&D tax credit, which is not refunded, or the Chinese R&D tax incentive, which is a tax allowance on thus which is not refundable. However, in this context, the qualification of the tax credit are not the sole criteria to determine whether they should be allocated to covered taxes or to the global income. The accounting treatment will also have an impact. So let's move on to the next slide. So the impact of the accounting treatment will differ between qualified refundable tax credits and other tax credits. Concerning the first one, so the qualified refundable tax credits, when this tax credit has already been treated as an income for accounting purposes, no adjustment has to be performed for the ETR calculation. For instance, regarding IFRS accounting rules, the French R&D tax credit is treated as an operating income in the nature of a grant. So no adjustment is needed for the ETR calculation. Please note that in this context, Pillar 2 rules do not aim at preventing countries to implement mechanisms to incentive certain sectors such as innovation or research. This explains why tax credits do not impact the ETR calculation. And the opposite, when the qualified refundable tax credit has been recorded as a reduction in current income tax, it must be treated as an addition to covered taxes for the ETR calculation. Why? To fully reverse the accounting booking that treats it as a tax reduction income instead of income. This ensures that the qualified refundable tax credit is treated as an item of income and thus does not impact as such the ETR computation. Concerning the other tax credits on the right in the slide, when it has been treated as an income, it must be deducted from the net income in the financial statements, and the reduction of adjusted covered taxes must be applied. When this type of tax credit has already treated as a reduction in current income tax, no adjustment should be made. So let's move on to the next slide. The impact of the tax credit, whether they are qualified refundable tax credit or not, can be mitigated by the substance-based exclusion rule. Indeed, for the calculation of the tobacco tax, the OECD provides that the global income may be reduced based on the substance of the entity according to a formula based on two things. The first thing is the calculation of a routine income based on salary on fixed assets. The second thing is the reduction of global income from this routine income. So generally, not top-up tax will be triggered when the company meet the substance test. And usually, a company benefits from already tax credit or something like this are very likely to meet this substance test. So the impact has to be mitigated with that. Thanks, Nadia. Yeah, thanks, Nadia.
Thank you, Romain. Thank you for this presentation. I think it gives quite a clear overview of the criteria, and I guess what many of us are worried about is the assessment of the US credits, and you already mentioned the R&D credits from the US, Canada, and China, but we know that there are many more in the system, and the US is continuing giving us more, and a proper analysis of all the credits and how they work, and whether we have the bad income. I really liked the slide, the bad income on the counter, or a milder effect on the global income will be very, a huge part of the analysis work, and hopefully also subject to further clarification of.
Yeah, because generally the tax credit, the condition of the tax credit is not mentioned, in the financial accounts. So you have to check. You have to check and to analyze each tax credit to know if you have to make adjustments to determine the ETR or the ETR.
Yes. Right. And in the meantime, I saw that we received a couple of questions, and my suggestion would be that we address them at the end of all the presentations. Regarding the slides, we will circulate them per email after the webinar, so there is no possibility to download them before. I apologize for that. Christos, may I hand over to you and your thoughts on substance carve-outs? You are still on mute.
You hear me?
Now I can hear you, yes. Perfect.
Super. So, good afternoon. Very excited that I will be discussing about the carve-out, which is effectively the benefit of the Pillar 2 to the taxpayers. Pillar 2 is not just about taxing, there is a carve-out, and which is a benefit for the taxpayers. Next slide, please. So the carve-out, as my colleague Nadia Romain mentioned, it has effectively two components. It's the payroll component and the tangible asset component. It provides for a 10% exception for the substance-based income exclusion rule. And this 10% is gradually reduced in a 10-year transition period to 5%. So for example, the payroll component starts from 10%, used in 10 years gradually to 5%, and the tangible asset component starts from 8% and gradually reduced to a 10 years period to 5%. Let me point out at this point is that here we're discussing about tangible asset, not intangible. Intangibles are excluded, and we're going to explain what is included in tangible assets and the payroll carve-out. Next slide, please. Now, an interesting point is that the carve-out is only provided to the multinational groups on a jurisdictional basis only in those jurisdictions that their effective tax rate is below the 15%. So as soon as you made your calculation and you end up to be below 15%, then the carve-out pops in order to artificially increase your effective tax rate. So in case that you are above the 15%, it means that the carve-out is wasted and cannot be benefited to those big multinationals that they have operation in jurisdictions that they are above the effective tax rate. However, I'm excited to be presenting two practical scenarios. One, when you are doing your tax risk assessment for Pillar 2 purposes and you identify jurisdictions that you are below the effective tax rate. So what you need to do in order to save your taxes, which is the norm. And also an idea, a planning idea that what do you do in case that you are above the 15%? So this means that automatically the substance-based income exclusion rule is wasted, how you can utilize that. So let me begin with the norm. What happens if you are operating in a jurisdiction that is below the effective tax rate? Next slide, please. So we assume that constituent 1 is resident jurisdiction A, and when you do your calculations according to the Pillar 2 rules, your effective tax rate is 11%. The substance-based income exclusion rule pops in automatically, so you don't need to do an election for that. You can use it automatically. And here, in our example, we have a payroll cost in that activity, which is 30 millions, and we have some tangible assets amounting to 170 million. So what will be the effect if we have this plain vanilla scenario? Next slide, please. So here we have the calculation and the effect. And the effect is what? Is that this company needs to pay a top-up tax percentage of 4%, which is the difference between the minimum rate and the effective tax rate. And then you need to calculate your substance-based income exclusion amount, which is 20 million. It's calculated based on the two components, the payroll component and the tangible asset component. Assuming that we're in the first year, there is a 10% exception. So the 10% of the 20 million, it will give us an amount calculating multiple to 4%. This amount will be 800,000, which is the saving of your substance-based income exclusion rule. So the key takeaway on this slide is that you are performing a global assessment on your Pillar 2 on a jurisdictional basis. You are operating in 20 jurisdictions. You identified in 5 of them you are below the effective tax rate. What is your next step? Your next step is to make sure that you get your payroll cost right, your tangible asset right. We are going to explain later on how you do that. But this is the key question, because here is how you effectively save money, reduce your taxes by artificially increase the effective tax rate, or on the other hand, lowering the income that will be taxable on the top-up tax percent. So this is the key takeaway of this slide. Let's go to the next case study. Now here we have another constituent entity that doing your effective tax rate, you end up being 20%. Here automatically you are wasting your only carve out in Pillar 2, so you have nothing to do, you cannot use it. Let's not discuss whether this is fair or not, but these are the rules. This is what the OECD says. What you can do is that assume, for example, and this is a practical case from a client, you are in the tech industry, so you have a light balance sheet, means that you are asset light, you are mainly relying on intangibles, so it's easy to move. You are not a manufacturing plant and it's difficult to move, although this can also be done. So what do? You say, okay, let me redomicile from jurisdiction A, which is the jurisdiction. Maybe my near country is a low tax jurisdiction, and I move there, which is a low tax, like jurisdiction B in the previous example. So if we redomicile from jurisdiction B, to jurisdiction A, from the high tax to the low tax jurisdiction, we will be able to utilize the substance-based income exclusion rule. So in this example, to be able to move, you need to be most probably employee intensive. Assume that your payroll cost is 40 millions and you have some tangible assets like 5 millions. What will be the result? Next slide, please. So Assuming that we move to jurisdiction A, our effective tax rate will be 11%, and the tobacco tax percentage will be 4% as well, the same numbers. However, here our substance-based income exclusion will be 40 millions multiplied by 10%. It will give us an exception of 4 millions of your taxable income. So here your excess income will be reduced by 4 million, and this will give us a saving of 160,000 euros, say you are in EU. Now, of course, other than utilizing your substance-based income exclusion rule, you also have some other side benefits. For example, you are going to save the corporation tax from the 20% to 11%. So it's like 9 million rough amounts here. And also, apart from the savings on corporation tax, we have seen recently in various countries around the world that they are introducing tax incentives on inward export in order to attack these tech companies. For example, Cyprus, we have recently introduced a rule saying that if you're an inward expert and your remuneration is more than 55,000 annually, 50% of your payroll taxes are exempted. So a rough calculation that we have done is that maybe you have a saving on your payroll cost like a couple of millions on this case at hand. So what will be the key takeaway on substance-based income exclusion on this case? That is that maybe when you have done your tax risk assessment and you said that these 5 jurisdictions are below the effective tax rate and you have these 15 jurisdictions that they are above, maybe you do an exercise saying, okay, how can I utilize my substance exclusion rule in the jurisdictions that I'm wasting it? So maybe there will be some opportunities there to utilize the substance-based income exclusion rule, the carve-out, in case that you are losing this carve-out. Next slide, please. So as soon as you decide that you are eligible for the carve-out, you need to take into consideration and get your numbers right. Important. So the payroll carve-out has 3 components. Now, who is eligible? The good news is that part-time employees are eligible, and also independent contractors are also eligible, provided that the M&E group controls those independent contractors. What is eligible effectively is all salary, wages, payroll taxes, social insurance, and so on. What do you see on your financial statements are payroll costs. Most probably they will be eligible. And where these employees need to be located in order to be eligible is a good question, especially post-COVID. We all need to work from home and we like working from home. So we are expecting the agreed administrative guidance from the OECD to let us know whether if an employee works in multiple jurisdictions or what will be the case in this respect. Next slide, please. Now, turning to the tangible asset carve-out, what is included? It's very important. Effectively, your fixed assets like property, plant, and equipment located in that jurisdiction. Care needs to be taken on assets that are difficult to locate them, like airplanes and stuff like that. So you need to be prepared in advance on what type of asset you have. Also, natural resources, right to use some tangible assets, some license of similar arrangements for government rents are also included on all assets. And next slide, please. And another question is how much? So when we identified what is included, we need to determine how much is the cost of the assets included on the tangible asset component. Here we have 4 issues that we need to take into consideration and you need to be careful. Is that the use of average, so it's beginning and end of the year in scope that we need to take into consideration. So we need to have an average on this, is incremental assets. We also need to eliminate any intra consolidation adjustments. So assets moving within the intra-group should not be taken into consideration. And also, we need to take into consideration the cost of acquiring the assets and not any revaluation that you might perform within your IFRS model. So, as you will see, the first key question is whether you are able to entitled to the substance-based income exclusion rule. And the second key question is how you get it right. And this is very, very difficult. We have seen from clients that extracting the data, get this right, is a data that actually you don't find it very easily in your financial statements. Of course, you can find it there, but there is a key question of extracting the data from your system. This takes time and money at the same time. So being well prepared how to calculate it right and save taxes is of a great importance. Now let me hand over back to my colleague Nadia to move on our interesting webinar. Nadia, I think you are mute. So.
Oh, thank you. Yeah, 2.5 years of pandemic didn't teach me. Thank you very much for this overview, and I think it's extremely important to point out what kind of structuring opportunities might be left or might be there within Pillar 2 in really doing a proper assessment of your substance, of your payroll costs, of your tangible assets, the effects of accounting method that it will have on the substance calculation. So thank you very much for this overview, Christos. And this already brings us to a summary of the key takeaways before we will go into the questions that we received during the webinar. So I think what you all took from the first presentation from Maria is that it's extremely important to identify the UPE because it's the entity that will ultimately determine your blending, the blending of the entities below. So if you have the UPE on a different level, it might be decisive to tell you on which participation string you will be obliged to blend different entities together, even they don't seem to be connected at all. And it also gave you an impression that there might be structuring opportunities in case you do not want to have the highest level involved within the definition of the UPE. So by changing the controlling interest, which does not necessarily include the ownership, so it might be possible to have that change without any tax implication, you might be able to redetermine which entity is the UPE and finally responsible under the Global rules. And might have an impact as well on the definition or creation of POPs, partially owned parent entities that are then responsible to actually levy the top-up tax. My part, the transition rules, it was go through your accounting if you're not IFRS and make sure that you have your deferred tax assets in good order, so you're not losing any assets when you're entering the global world. And also monitor what kind of restructuring you're doing right now, which is leading to taxation. So everything that is carried out at book value is not critical, but everything that is done at fair market value might be an issue in the future years, depending on how the OECD will address that. On this matter, restructuring or preparatory restructuring, you might also want to watch out for anything that would not qualify as a global restructuring. So under German law, for example, we also know a couple of restructuring methods that are not requiring to issue new equity on the recipient entity. So if you have anything planned in this respect, and this normally concerns the transfer of property as well, which might be high value, you might not be allowed to have the book value for accounting purposes, which could then also have a negative effect on the ETR calculation. So if you have any restructuring plans, just make sure that you're keeping Pillar 2 already in mind, and maybe you take do it a little earlier, do it next year, or make sure if you do it when global rules are in place, that you make sure that it qualifies as a global restructuring. Then Andreas quite plastically demonstrated the problems arising with the different definitions. Well, first of the impact of loss carry forwards, so that you can have impact by the first of all by the recast of the DTAs coming from the loss carry forwards, which should bring you to a 15% ETR. But obviously, if you have additional impacts besides using a loss carry forward, like for example dividend income that is not treated as exempt, well, that is treated as exempt income and not as not exempt income as portfolio. There might be additional effects that bring you into a low ETR, even in situations where you wouldn't expect it, like for example Luxembourg, where the tax rate is not close to 15% at all. Also very important was the analysis of tax credits under the French IP regime that was presented by Romain. And I think this will be something that will be quite an intensive work once the domestic rules are out, to actually assess what kind of credits will be considered in which direction, and whether it will lower your covered taxes or whether it will only increase your global income, because that has quite significant impact on the ETR calculation. And then last but not least, Christos for the overall analysis of the substance carve-out, because quite correctly pointed out, if we are in a world of global minimum taxation, if you want to bring down the ETR, and due to the substance carve-out, your ETR will not be 15%, but it can still be below that if you structure wisely and you bring the substance to the extent possible, and considering obviously European exit taxation into countries where taxes might be a little lower, but with the substance carve-out you're still able to get the lift up to not be subject to any top-up tax. So this will bring us to the question that we have received, and I will start with the first question that was brought to us considering trust, and whether, let me see, in the determination of the UPE, is a trust considered an entity? And Maria, you are our expert on UPE, so I hand this one to you.
Absolutely, Nadia, thank you. Well, yes, if you look at this question and see if trust is a UPE, you have to, because an ultimate parent entity has to be an entity in itself. And then it comes back to the definition of entity, and that is defined as either a legal person or a legal arrangement that are to prepare separate financial accounts, is the definition. So normally, at least, a trust is not a legal person in itself. Could be the case that it's a legal arrangement, but then also, which has to be looked into and analyzed carefully, of course, but then also this add-on that it has to be liable to prepare separate financial accounts. Also important to have in mind. So you have to kind of go back to that definition, and in case it would not fulfill the definition of being an entity in itself, it cannot be an ultimate parent entity. So then you look kind of on another level to see, is there anyone on top there that is required to consolidate or not? And if there is no one, kind of, if let's say that company Z is the trust here in this example, and you have owners holding in the trust, then if you have any of the owners above that are required to consolidate, then you would, and you have concluded that the trust is not an entity in itself, then it could be that there are levels above that are required to consolidate, and could be UPEs. Otherwise, we will probably end up with going down in the chain instead. below the trust to identify the ultimate parent entity there.
Yeah. Yeah, and I think there is currently still a sort of discrepancy a little bit in the definition and what they envisage to do, because we also see it in Germany. We have a lot of Familienstiftungen, yeah. So it would be a legal person in that sense. So it would be in the definition of entity, definitely. But by determining who does the consolidation for the group, and also if we think about stapled structures, there is something that you can actively manipulate in that sense by shifting it around, as you pointed out, Maria. So yeah. So it's not a generic answer, I'm afraid, but you will reach out to Maria if you have any further questions. We then had another question relating to funds, and I guess that's naturally Andrea's topic. So it's, do you need to make an assessment of the investors in the fund concerning their consolidation obligations, including partially their share in the fund? Is the UPE definition here also the same with that used for CBC reporting obligations?
Yeah, thank you, Nadia. Maybe we can split the question to Maria, and you can comment briefly on the UPE, because as a rather general point, like investment entities or investment funds, most of them should be considered as excluded entities under the GloBE rules. It means, like, provided they meet certain criteria, for example, like a certain degree of regulation, either directly or through the manager, like the marketing or like the pooling of assets for a number of investors, according to a specific like investment policy, for example, that would lead to like the inclusion, including also like the entities below the fund, which are fully held usually. There are like a few like still like uncertainties around these questions, especially like when you have like feeder funds, for example, which are not like widely held or like marketed to a number of investors. But as a matter of principle, like a normal investment fund should be carved out from those rules.
Yeah, I have to admit, investment funds are not my facility. But I think there was also like an election right where you could choose to have them in. But yeah, as far as I understood, they're normally excluded. Maria,
yeah, there are a few practical questions still. That's why this is more like a broad reply.
Yeah, and just to add on there, yeah, what we have seen is from a country perspective is that there could be definition differences, unclarities. If something is investment fund under local rules, it's not necessarily the investment fund under these rules. So still a lot of question marks here, what we have seen. But I would say in relation to the UPE, it's kind of the same exercise you need to do if it's not an excluded entity. You have to go back and see if it's an entity. If it's an excluded entity, then you have certain rules in relation to underneath as well. So those are particular rules, I would say. But if it's not an excluded entity, it's the same kind of exercise you do, looking if it qualifies as an entity, and then if it's required to consolidate underlying companies as well.
Yeah, regarding the whether it's a reference to, there is no direct reference made to the CBC.
Yeah, I would say that in relation to the CBC definition of the ultimate parent entity, it's a little bit different in how the exact wording is outlined in the CBC rules. It says that it's required to consolidate as well, but not necessarily. It says on a line-by-line basis. So it's slightly different in the definition of how it's outlined in the wording. But I would say that the meaning of what it says is that it comes back to if you're, as an entity, required to consolidate underlying entities, but not in itself is held by an entity that is required to consolidate up that entity.
Yeah. Yeah, and you would wonder because I know, because I was working for the OECD, that the same teams are involved in CBC and in Pillar 2. So you would have expected, if they wanted it to be the same definition, that they would have just made the reference. But I guess they wanted to keep some leeway for them to, go with further guidance and not have it interconnected.
Yeah.
So there was another question, and I think, Andreas, that would be also for you. If you have a US parent entity with 2 UK holding companies underneath, with 2 towers of subsidiaries and no common UK intermediate holding company, where will the top-up tax be imposed?
Or is that not rather for Maria, the question, or is it for me?
Well, yeah.
I can comment, Andreas, if you want.
Yeah.
And I would say that what I would do, looking at that, would be to, if you have a top US parent company, that to see is that parent entity required to consolidate the underlying companies, and if it is, then we would most likely end up with having the ultimate parent entity in the US. So it here all comes down to the consolidation requirement, if it is required under the financial accounting standards to consolidate the UK companies. So then it would be the UPE for the underlying entities.
Right, but now we have the US who doesn't want to implement the global rules.
Yeah.
So I guess where it leads, that you would
Exactly.
levy the top tax on the level below, and it would be my understanding. So first of all, everything that goes directly to the US would be subject to the UTPR, and everything that is below that, if the UK would implement a valid income inclusion rule, a qualified income inclusion rule, my understanding would be, if they're both 100% and not POPIs, that they would yet still be the ones that would levy the top-up tax. And then the question arises whether, and there's the question that you're asking, whether you only levy top-up tax for each of your tower that is below you, or whether you still had to do the global blending, the jurisdictional blending on the levels below. And from the mere definition, what you would have to do, let's say you have the 2 British entities, the UK entities, and they both have under their own tower of subsidiaries entities in Switzerland, that you would still have to blend them together. And then you allocate the income tax, the top-up tax, and we can go on the very first slide. I jumped that a little bit in the beginning. So the allocation to the individual entities is done by the respective global income of each of the constituent entity. So what you would do, you would calculate a top-up tax for, then, let's say, Switzerland. You would then allocate it to the different entities, to the different Swiss entities, no matter who was low tax, just by the global income. And then you would go up the shareholding to both UK intermediate parent entities, and then they would levy their respective shares, even though they are no POPIs. I hope this addressed the question, and obviously I don't know if that's right, but that's how I would read. I mean, we had this phase, and that's where we analyzed it, and that's how we would read it. And obviously, and being headquartered in the US can be, quite burdensome. I mean, if you have on the second level something, then you would could still switch out the application of the UTPR, but obviously everything that goes directly there would be subject to UTPR, which means that you have a lot of work in front of you to determine the UTPR share of each jurisdiction. So we have another question. How foreign tax credits should be treated? Are they qualified refundable tax credits or other tax credits under Pillar 2 rules? Romain, I think this is...
Yeah, exactly. For the foreign tax credit, so please remind that for Pillar 2, we have to analyze whether or not the tax credits are refundable within 4 years. If yes, they are qualified as refundable tax credits. Otherwise, there are other tax credits for Pillar 2 purpose. So from a French tax standpoint, but I think it's the same in other countries, French tax credits are not refundable at all. So they are treated as other tax credits for Pillar 2 purpose. And generally, in IFRS accounting tax rules, I think that they are not considered as income, so no adjustment has to be done in this side.
Yeah, that's just a whole topic on itself. Christos, there is one question coming in for you. What are the practical challenges, difficulties in calculating the SBIE?
Yeah, the main issue is a very good question, actually, Nadia. The main issue for calculating your tax-free income, let's put it like this, mainly this is data that you need to extract from your system that is not easily found, especially in financial statements. So, for example, if you have part-time employees or independent contractors and you are working massively with, the concept of economic employer and stuff like that, maybe this is data that you don't easily have it in your system when you are doing your accounting. So you need to establish a mechanism in that jurisdiction for all constituent entities in order to extract your data right. Because the good news is that all these employees, part-time, contractors and so on, it's good news that they are there, but usually they are not in the accounting system. So you need to establish another mechanism, another system to get this out and make the calculation. So this is an important part. Another part is to get your tangible asset right, because it's based on location, but what location means, type of assets. And there are also some overlap between, sometimes you capitalize your expenses, your payroll expenses, so maybe it is in one category or the other. So you need to count them once. There are special rules for this, not to avoid double counting. Or if you have international shipping, you get them out. So it really depends when you get into the nitty-gritty details of the both, payroll component and the asset component. I will say the asset component, the biggest issue will be to get the value right rather than identifying the assets. The assets you exclude mainly intangibles, goodwill, inventory, and anything else most probably will be excluded. However, the value, it is the biggest issue. Finding the average, getting out the revaluation, eliminate any intra-group balances, and stuff like that. It's critically important to get it right, because the more precise you are, the less taxes you pay. So this is your benefit, and you want to get your benefit right.
Yeah, that tunes perfectly in with the next question. Are there any technical solutions available to facilitate the handling of Pillar 2 in practice?
Get another system.
Yes. There are two answers, a couple of answers to that. So, of course, we have the typical players in the market that are developing tools, and I have to advertise at this point our own tool of FGS Digital that also won a Tax Tech Award recently. And I guess you would need some sort of technical support just to, as Christos pointed out, to keep track of those additional information and do the downcast of deferred taxes, etc. But I guess, to be very frank, it's a bit vulgar speaking, shit in, shit out. You have to get your data right, and you have to do that work, and no one can shortcut that. So once, when preparing and setting up, you will have to get straight which kind of information you will need, and set up a process to get the data ready, on which any tool can then work on, and then this will be the main benefit.
On this, Nadia, if I may add a quick point, discussing with the clients, I mean, they are complaining. Of course, if you can get a system to make the calculation is one thing, but the biggest issue that clients will have is to extract the data from their system to include it in the new system. So the problem that they have is that they need to have like 3 systems. One is for accounting purposes, and sometimes they have 2 accounting, one for the local accounting and one for global reporting. Then you need to have another system for your tax purposes to get your tax right. And now they need to have another system for getting Pillar 2 details ready. So, it's getting over and over burdensome for clients. I mean, they need to have 3 different systems just to comply, which is problematic, I would say.
Now you effectively put a third layer, a third process, throw it into the game. And indeed, what we are doing when we're digitally advising, so let us know if you want to have a series on the digital implementation. We can also present the tool and how it works, is that we build on the consolidation process, and that we adapt the consolidation process so that you get the right data during the reporting that you have to do anyways. And then the benefit of the tool is that the adaptation calculations, like, as I said, recast of deferred taxes, or having a loss in the full amount, or doing the calculation of average employee cost, that is an additional information that you put in there, that this kind of tracking is in there, that you can simulate the election, like it's different elections, whether it makes sense to do the global loss election or not, and if you're above the ETR, that you don't use substance carve-out, this kind of things. So now that we are running a little bit out of time, you will find in the slides, thank you, Andreas, a comparison of the exemption, participation exemptions from different countries. So this is just a broad overview, and we're still working on that, where you might run into problems. And I thank you very much for your attention today. I hope you enjoyed the session. We're looking forward for your input, what to focus on the next webinar. Otherwise, we have a long list of items, and it's lunch break is only that short. As a little reminder, speaker profiles and info can be found in the presentation, and we will circulate the presentation to all attendees after this event. And if you have any specific queries or set up other webinars, please email to taxand@taxand.com, and you will be directed to the appropriate contact. And otherwise, thank you very much for your attention, and have a lovely afternoon.
Goodbye.